This video will discuss how to prepare cash flows using the traditional indirect method. This is a part of a series of weekly videos focusing on making you cash flow experts in no time. Welcome to Accounting Zero to Hero. The objective of this video is to provide guidance on the first way of preparing the statement of cash flows. You will recall that the videos in this series will be shown in the following structure. In this diagram, this video discusses this portion right here about the traditional indirect method. I call it traditional because exams are normally structured around this type of cash flow preparation. That is why this method is perfect for students who are more exposed to exam type of cash flow questions. Though I have to say that in practice, this is my least favorite way of preparing the statement of cash flows. You will know about why later. Let's formally start the discussion with a recap of the indirect method. It is important to emphasize here that the indirect method pertains only to the operating activities. There are no such alternative methods for investing and financing activities. Some parts of this section have been taken directly from the previous video on cash flow introduction. If you want to see that full video, the link is in the description. The first important thing to remember is that the most common way of preparing cash flows under the indirect method adjusts the reported profit or loss for the effects of changes in inventories and operating receivables and payables during the period, non-cash items such as depreciation, provisions, deferred taxes, unrealized foreign currency gains and losses, and undistributed profits of associates, and all other items for which the cash effects are investing or financing cash flows. Another thing to remember is that the reconciliation should start either with profit or loss before tax or profit or loss after tax. Any other basis such as EBITDA, EBIT, or profit or loss excluding NCI does not meet the requirements of the standard. Let's now move into the heart of the discussion. All the cash flow examples that we will discuss will be coming from a single dataset that we have prepared. This is to emphasize how all of these ways of preparing the cash flows will result in the same cash flow data in the end. We will be working with three particular tabs. The first one shows the balance sheet of AZH Company Limited for 20x2, which is the current year, and 20x1, which is the previous year. We also have the income statement of the company for the current year, and some additional relevant information about the current year transactions. In particular, a piece of land costing $25,000 was sold for $35,000 in cash, resulting to a $10,000 gain. Plant assets or property, plant, and equipment costing $50,000 was purchased by issuing a long-term notes payable, meaning it was not paid in cash. A portion of this notes payable were paid before year-end. AZH Company borrowed an additional $100,000 from the bank. Dividends of $218,000 were paid to shareholders. The company issued $5,000 worth of common stock for cash during the year. And lastly, the associate or investment in associate that we see in the balance sheet is 30% owned. During the current year, it generated profits of $100,000 and declared total dividends of $50,000. The second tab shows the general ledger of the company during the year. In particular, it shows all of the journal entries from January up to the last journal entry entered by the company in December of the current year. And lastly, the last tab shows the cash book or the bank statement of the company during the year. As a way of checking, the beginning balance of $255,000 and the ending balance of $350,000 agrees to the cash balance in the balance sheet that we have shown previously. All of these videos will be using these data in varying amounts depending on what type of cash flow preparation we have chosen. This means that these three tabs may not entirely be relevant for a particular problem. To obtain this specific file, you may email us at contact@accountingzerotohero.com. Otherwise, you may follow the discussion and apply the concepts to the specific problem that you are currently working on. Let's go! The traditional way of preparing the statement of cash flows is mostly done when you are doing exam type questions wherein sometimes not all data about the company is provided. You can also be asked only about specific items in the cash flow preparation process, like the amount of taxes paid during the period or the amount of interests paid during the period, for example. To prepare for this type of cash flow, you need to do the following. Step 1. Familiarize yourself with the company. For example, in actual practice, you won't really be given this summary here, but you need to dig deep into the GL to know the transactions during the year. It helps to read every single one additional information so that you know and you can assess what will be the impact of these additional information to the cash flow that you will be preparing. Step 2 is to take notes. By familiarizing yourself in the given data, you can take mental notes or actual notes about the important points to be able to build the pro forma statement of cash flows. In particular, you need to scan the income statement because this is what the standard said you should start from. Here is a quick recap. When scanning the income statement, you need to take into account two things. Number 1, any non-cash components of net income like depreciation, amortization, and deferred taxes. And number 2, any component of net income that, while may be in cash, pertains to investing or financing activities. Applying step 2, for example, we can scan the income statement and know the following. During the year, we have depreciation expense of 20,000, which is a non-cash component. We also have gain on sale of land, which is an investing activity. We have share of profits of associates, which is also an investing activity. And lastly, we have interest expense that we have to take note of because we will be converting this to interest paid later in the cash flows. Apart from scanning the income statement, we also need to look into the special transactions to know about the investing and financing activities. Here, we know that there are investing activity transactions during the year, which are Transaction A, Transaction B, and Transaction F. You can revisit our introduction to cash flows to know why they are specifically classified as investing activities. We also know that there are financing activities during the year, which are all of the remaining Transactions C, Transaction D, and Transaction E, because they are the transactions related to the borrowings and equity of the company. You can also achieve this type of analysis by looking into the movements of the non-cash assets, non-current liabilities, and the equity section of the balance sheet. Specifically, these items. Especially in actual practice, additional information is not available. So you have to check the movements of the non-current assets for investing activities. Non-current liabilities for financing activities, and equity for financing activities, so that you will be able to have an idea what are the other items or what are the other additional information you have to consider for your cash flow preparation. Now that you have already built up your expectations in step 2 by taking notes of what are the different movements in the balance sheet and what are the different movements in the income statement, we're now ready for step 3. The next step that you have to do is to lay out your cash flow template. We already did this in this tab here. Normally, you can pick up any type of pro forma cash flow that you can find and lay it out, complete with all of the formulas and all of the expected captions based on what you have determined from step 2. Don't worry too much about this part because you can add rows, you can add captions, you can change formulas as you try to understand and you come up with the statement of cash flows based on the data that you will be working on. And that's step 3. In step 4, you need to determine which sections of the cash flows you will need separate workings. For example, when you need to disclose taxes paid or when you have paid taxes during the year, you have to create a taxes paid workings, which is workings A. Interest paid would be working B. Repayments of note payable as working D. And other workings that might be needed for support that you can identify. For me, for example, we have working C to check the roll forward of the investment in associate, and workings E and F to summarize the movements in working capital. Once you have gone through all of these steps, you are almost ready to start putting in the figures. But now we have to go through step 5, which is one of the most important ones. Step 5 is to know the goals. Know the goals of the cash flow that we are going to prepare. Goal number 1, the ending cash balance should be equal to the cash in the balance sheet by the end of the process. The ending cash balance is right here. If everything is connected through the formula, then as you enter amounts in the different sections of the cash flows, then you will already have an expected ending balance. And that ending cash balance here should be equal to the cash balance that we have in the statement of financial position, which is here, the current year, 350,000. This is a check that we have inputted to be able to see whether the ending cash balance we have in the cash flow after inputting the figures will be equal to the cash in the balance sheet. Once this is 0, then I can say that maybe 90% of your job is done. You see, the reason why this is my least favorite method of preparing cash flows is because of the trial and error nature of doing it. You input numbers here in the hope that it will end up balancing in the end. Of course, there is a more systematic way of doing it that we will explain in the next video, which is how to do the cash flows through the cash flow worksheet. That's goal number 1, about the cash in the balance sheet reconciliation. Goal number 2, the first section of the cash flows pertaining to the reconciliation right here, should agree to the statement of profit or loss. Meaning that it is sometimes as easy as actually linking them to the P&L. All of this here. This one should be the check should be 0. All of the missing data here without captions or without notes means that we can take it directly from the data derived from the additional information or from the GL. You will see that later. All the other steps that we need to do after step 5 to complete the cash flows will now depend on the data and specific issues that you will encounter. But in general, once you achieve these 2 goals at the end of the cash flow process, you can already be comfortable that your job is complete. With that said, we can now start inputting numbers into our cash flow statement. You have to remember that in general, as a guiding principle, positive items in the cash flow statement mean that you received cash or the company received cash, and negative items mean that the company spent cash for this particular activity. That's why in the profit or loss after tax, if it's a profit, it should be a positive amount, and if it's a loss, it should be a negative amount, because profit means that potentially we received a net amount of operating activity cash flow before recognizing the adjustments to reconcile the net income to net cash flow from operating activities right here. So now we have 124,500 positive item because we have a profit of 124,500 from the income statement. As agreed from the notes here, all of this should agree to the P&L. This section right here, you have to remember that whatever amount you put, it should be the reverse of what's in the income statement. For example, for the depreciation, we know that the depreciation during the year is 20,000. It is a negative in the income statement because it's an expense account, meaning in this 124,200, the 20,000 was deducted, so we have to add it back. So now it's going to be a positive 20,000. Same goes for the gain on sale of land. We have 10,000 gain on sale of land in the income statement, which means that the 124,500 was increased by 10,000. But since it is an investing activity, we have to remove this 10,000 from this 124,500. So it's going to be negative 10,000, which is a reverse of the sign of the one that we see in the income statement. Same item with a share of profits of an associate, because this is an investing activity. We have 30,000 of share of profits in the income statement, which means that we have to input a negative 30,000 in the statement of cash flows. For both interest expense and income tax, they are both operating cash flows. But since we are using accrual basis in the 124,500 net income, we have to remove the impact of the interest expense and income tax in the profit or loss after tax. And later, we need to input the amount of taxes and interest that were actually paid using workings A and workings B. So now, the interest expense, it was deducted in the income statement by an amount of 15,000, so we're going to add it back. Same with taxes, we're going to add back 30,000. I would say we can skip these parts for now. Normally, we put this towards the end, the increase or decrease in working capital. So now, let's learn how to do the taxes paid and interest paid. We're going to use workings A and workings B to work out the amount of taxes and paid during the year. First, we input how much is the beginning of the tax payable. For this, we need to always check the balance sheet. In the balance sheet that we have, the beginning tax payable is amounting to 35,000. We input the ending tax payable amounting to 55,000. And then we input the income tax expense amounting to 30,000. What happens now is that we're going to find a figure that will make the income tax payable from 35,000 when we add the income tax expense, and then we deduct a certain portion, it will become 55,000. In accounting, we call it squeezing. This happens because in the beginning tax payable, the entry to record income tax expense is a debit to income tax expense and credit to income tax payable. Hence, right now, after the income tax expense, we are expecting 65,000 of income tax payable. However, in the balance sheet, we only have 55,000 of tax payable in the ending balance, which means that we have actually paid 10,000 of taxes during the year. Normally, you can do this by getting the ending balance less the beginning tax payable less the income tax expense. So we have the actual taxes paid of 10,000. We can link it over here like this. And you're done with that section. We will do the same analysis with the interest paid. The beginning interest payable is amounting to 65,000 according to the balance sheet. And the ending interest payable amounts to 70,000 in the balance sheet. With an interest expense of 15,000, which means that we have debited interest expense and credited interest payable, we are expecting a balance of 80,000 in the interest payable. However, since we have 70,000 as an ending balance, it means that we have actually paid 10,000 of interests during the year. By the process of squeezing, this 10,000 will now forward into the interest paid section of our cash flows. This means that tax paid during the year is 10,000 negative because we paid it. Interest paid during the year is 10,000 as well, negative because we have actually paid this amount during the year. Let us quickly proceed to the investing activities. Proceeds from the sale of land. Normally, we can get it directly from the additional information. The question is, how much cash did we receive when we sold the land? And the answer is 35,000. Cost of new plant assets means that how much cash did we spend from buying plant assets? The answer right now is 0 because the 50,000 increase in plant assets is actually paid through a long-term note payable. And the payment of that long-term note payable goes to the financing activities, which is in particular working D. The dividends received from associates for this problem needs a little bit of computation because we're saying here that the associate is 30% owned. With 30% ownership and the total dividends declared of 50,000, it means that the company received 15,000 of dividend during the year. It will be a positive amount because we received cash from the associate. Now, cash flows from financing activities. We will be requiring working D for the repayment of notes payable. The brought forward balance or the beginning balance will be 0 because at the beginning we didn't have notes payable. When we purchased land, debit land, credit notes payable, it increased by 50,000. But now the ending balance is 30,000. It means that during the year, we paid a portion of the notes payable amounting to 20,000. And here we're going to link it like this. Proceeds from additional bank borrowings can be taken directly from additional information or from the GL. Whatever information is more available to you. But right now, we know that 100,000 was received from the bank. Proceeds from issue of common stock. We also know that 5,000 worth of common stock were issued during the year for cash. So we're going to input here a positive amount of 5,000. Dividends declared and paid. It means that how much cash did we actually pay the shareholders? It is in the additional information amounting to 218,000. Remember that it's going to be a negative because we made an actual payment to the shareholders, meaning cash were spent. We have a difference of 303,500. However, I'm seeing that we forgot to input the beginning cash balance because here the formula is the movement in cash plus the beginning cash balance is supposed to be the ending cash balance of 350,000. At the beginning of the year, we have 255,000 of cash. Right now, I'm seeing that we are missing 48,500. But the good news is, we haven't actually inputted the working capital movements. This is normally the last thing that I input because this is going to be the net effect of all of the other items that you have not yet considered in the cash flows. Normally, this refers to current assets and current liabilities, as we have mentioned before. In Workings E, we're going to calculate the current asset movement. As a rule of thumb, you have to remember that for the cash flows, an increase in asset would mean a negative amount because we are assuming that cash was decreased. A decrease in asset would be a positive amount because cash was increased. On the contrary, liability amounts would have opposite effect. An increase in a liability account would mean an increase in cash, and a decrease in a liability account would mean a decrease in cash. It all actually follows debit and credit conventions, as you see in the screens. For example, for Working E, accounts receivable decreased by 11,000, which means that we're going to have a positive amount here. Prepaid insurance likewise decreased by 25, so it's a positive amount, and inventories increased by 30,000, so it's going to be a negative amount. So it's going to be 16,500 net increase in current assets. Lastly, current liabilities. We see that the accounts payable increased by 60,000, which means that cash increased by 60,000. And lastly, salaries payable increased by 5,000. So we have a positive amount of 5,000. If we link this to the cash flows, we see that the check is 0, which means that most likely this is the actual cash flow that we already have, and this is final. How about investment in associate, Working C? Let's check it out. The brought forward balance, or the beginning balance of the investment in associate, is 120. The ending balance is supposed to be 135. We know that the share in income in the income statement was recorded as 30,000. And the dividends that we have is 15,000, so it's a negative 15. This is just for us to check if the movements in the investment in associate agrees to the ending balance. So right now, we have the sum of all of these three is 135,000. So we're saying that the investment in associate movement is actually correct. What do you do then when you're stuck and you see that the cash flow is not actually balancing? Since this is a sort of trial and error type of cash flow preparation, you really have to check step by step if you have accounted for every single movement in the balance sheet into your cash flows. For example, if we go through the balance sheet accounts, we know that the accounts receivable, prepaid insurance, and inventory have been accounted for as working capital movements. The investment in associate movement of 15,000 has been accounted for in the share of profits and the dividends received. The 25,000 land has also been accounted for in the proceeds of 35,000 less the gain on sale of land of 10,000 in the operating activities. Also, the plant assets have been accounted for as part of the notes payable in the Working D. Accumulated depreciation of 20,000 has also been accounted for in the depreciation adjustments to reconcile net income. In the current liabilities, accounts payable and salaries payable are accounted for as working capital movements and interest payable and income tax payable are accounted for in the tax paid and interest paid. The notes payable are accounted for in the financing activities as well as the bank borrowings, and then the equity movements are accounted for as well in the financing activities. In particular, retained earnings of 93,500 includes the movement of the net income and the dividends declared of 218,000. If you miss something, then your cash flow will not be balancing. You should also double check if you have accounted for all of the income statement items properly, and if you have inputted the correct sign in all of your accounts. For example, if you forgot to put a negative sign in one account, you will see a difference in your cash flow check. In this type of cash flow preparation, you have to be careful that all of your inputs are perfect so that the cash flow will balance in the end. And that's the challenge for this type of cash flow preparation. Hopefully in the next lesson, you will be knowing how to systematically do it to eliminate the trial and error portion of the cash flow preparation. Sometimes in exams, you will also be told to provide how much taxes paid and interest paid there is during the year. And in this case, you will need this type of cash flow workings. In the next lesson, you will see that when we do the cash flow workings as a type of solution for this problem, we will arrive at the exact same amount of cash flow for operating activities, investing activities, and financing activities, but we did it in a more systematic way. This video summarizes the steps in the traditional indirect method cash flow preparation. Step 1. Familiarize yourself with the company. Step 2. Take notes. Scan your income statement and look for non-cash components of net income and any components of net income that, while maybe in cash, it pertains to investing or financing activities. Step 3. Proceed to input the layout of your cash flow template, complete with formulas and cash flow captions. Step 4. Determine which sections of the cash flow you will need separate workings, like tax paid, interest paid, repayment of notes payable, just like our example. And lastly, note the goals of the cash flow template. Goal 1. The ending balance should be equal to the cash in the balance sheet by the end of the process. And Goal 2, the first section of the cash flows pertaining to the reconciliation of non-cash items should agree 100% to the statement of profit or loss. In the next video, we will discover how to do all of these things using a cash flow worksheet. Hope to see you next time.